In January 1980, silver was supposed to replace trust itself. For a brief moment, it nearly did. The price of silver exploded from around $6 an ounce to almost 50. People lined up to buy coins. Jewelry shops ran out of stock. Newspapers warned of shortages, panic, and the collapse of paper money. But this was not a natural boom. It was engineered. Behind the most dramatic silver rally in modern history stood two men who believed the global financial system was fundamentally broken. Their names were Hunt brothers. Nelson Bunker Hunt and William Herbert Hunt were billionaire oil tycoons from Texas. They had seen inflation explode during the 1970s. They watched the U.S. abandon the gold standard, and they reached a simple conclusion: paper money was doomed. To them, silver was not just an investment. It was insurance against the collapse of trust. So they began buying. At first quietly, in the early 1970s, they accumulated physical silver, not paper claims, not certificates, but real metal. Bars, coins, warehouse deliveries. Eventually, they controlled more than 100 million ounces of physical silver, close to 1/3 of the world's freely available supply. But physical silver alone was not enough. They wanted control over price. Using futures contracts on the COMEX exchange, the Hunt brothers began buying silver on margin, borrowing heavily to increase their position. Every price increase strengthened their collateral. Every rise allowed them to borrow more. This created a dangerous feedback loop. As silver prices rose, investors noticed. Fear spread. Retail buyers rushed in. Silver was suddenly framed as the people's metal, cheaper than gold, easier to access, and supposedly safer. By late 1979, the market was overheating. Governments grew nervous. Banks were exposed. Regulators realized that a small group of investors had gained unprecedented control over a strategic commodity. And then the system pushed back. In January 1980, the COMEX exchange introduced emergency rules. Buying silver futures on margin was restricted, then banned entirely. Only selling was allowed. Overnight, demand vanished. The price collapse was violent. Silver fell from nearly $50 to below $11 an ounce in a matter of weeks. Margin calls hit instantly. Loans were recalled. The Hunt brothers could not meet their obligations. On March 27, 1980, a day later known as Silver Thursday, the market officially broke. The brothers lost billions. They were later fined, sued, and permanently banned from commodity trading. Their financial empire never recovered, but the impact went far beyond two investors. This event reshaped global commodity markets. Position limits became stricter, leverage rules tightened, and regulators learned a critical lesson. A market does not need to be small to be fragile. It only needs leverage. Now, fast forward to today. Silver is rising again, not because of a single group trying to corner the market, but because the world itself has changed. Unlike gold, silver is both a monetary metal and an industrial metal. Over half of global silver demand now comes from industry: solar panels, electric vehicles, medical equipment, electronics, military technology. The green energy transition alone consumes massive amounts of silver, and unlike oil or copper, silver is rarely mined alone. It is a byproduct, meaning supply cannot easily respond to rising demand. At the same time, central banks continue to print money. Interest rates rise, then fall. Debt levels reach historic highs, and trust, once again, becomes fragile. Investors return to silver for the same reason they did 50 years ago: not to get rich quickly, but to protect purchasing power. But there is a crucial difference. Today's silver market is far more regulated than it was in 1980. Large position limits exist. Physical shortages are tracked more closely, and leverage, while still present, is not as unchecked. Yet the memory remains. Every sharp silver rally revives the same question. Is this real demand, or history echoing itself? Because silver has always behaved differently from gold. Gold moves slowly, driven by central banks and long-term reserves. Silver moves violently, driven by fear, industry, and speculation. It does not whisper, it spikes. In 1980, silver exposed the weakness of leverage. Today, it reflects something else, a world running faster than its resources. Silver is not just a metal, it is a signal, and every time it rises suddenly, history leans forward and listens.